and welcome to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Now, joining me and my colleague Chirag today is Ashish Gupta. He's CIO at Axis AMC. Welcome, Ashish.
Happy to be here. Thanks for having me.
Good to have you here. My first question to you: what sparked your interest in the financial markets? Was there a defining moment or an influence that set you on this path? What was it?
Sure. So I think we really came to the financial markets, or actually got interested in corporate India in 1990s. And I would say for me, really the defining moment was the era of Manmohan Singh. So I call us really as big beneficiaries of the liberalization that he unleashed. And I was in college back then, and I distinctly remember his seminal speech in the parliament where he said idea of India as a economic powerhouse is something whose time has come. I think he quoted Victor Hugo in that speech, saying that no power on earth can stop an idea whose time has come. Right, and we were in college back then, and there was also a big stock market boom that was happening in 1990, 91. So all that kind of really gravitated my interest into the corporate India and financial market, because prior to that, really, corporate India was a world unknown to, I think, most Indians outside Mumbai.
Now, Ashish, from analyzing the debt crisis at Credit Suisse to becoming a CIO at Axis AMC, what's the biggest lesson that guides your decision?
So, Chirag, I think one thing I have kind of realized over the years is that it is very important to remain objective, right? And I think it is becoming more and more pertinent in this age of media overdose, in this age of social media, because what happens is that all of us get the same news, the same information at the same time, right? And all our thought processes, all our reactions become very, very similar. I think the propensity to fall for narratives is very high. So the crowd thing a lot of time overtakes what you would rationally think, right? And I think for me, therefore, it is very important that you should keep looking at data, try to be as objective as possible. And even now, what, almost 12, 14 years ago, during the time of House of Debt as well, really, it was not that I did an analysis or I had access to data that were different from what was available to anyone else, right? But I just kind of looked at it more objectively for what it was, rather than just glossing over it, saying that, okay, this is a big conglomerate and nothing will ever happen to it, etc. Right? And I think the same holds true today. So when we look at companies, when we look at stocks, we should not get really enamored by the lens that say market or media is viewing at. Right. So I think that is the most objective, that don't fall prey to narratives, be as objective as possible. And the other thing, of course, is that we have to remember there are ups and downs, there are cycles. So you have to remain calm and patient through various phases. So don't get sucked in if there is really hey, everyone is chasing a stock, or don't throw in a towel when everyone just sees doom and gloom. So I think that calm and patience and belief in your own conviction is really the most important element of being able to really true to yourself.
But Ashish, how do you become rational in this irrational market? In the last few years, we saw frenzy markets going up. Now we are seeing a sharp corrections. So how to become a rational from an investor point of view?
Yeah, so I think you are absolutely right that, and I think who said this? I don't remember. Like markets can remain irrational longer than you.
Yeah.
So I think that is absolutely true. But I think the good thing is that if you are able to avoid large mistakes, right? So if you will still do relatively okay, and again, you don't need to be perfect in these markets or perfect at all points of time. I think if you keep kind of learning from your mistakes, if you kind of keep your basic sensibilities right, I think you will avoid large mistakes. And I think at most points of time, that is adequate. It may not kind of make you a superstar investor. But the fact is that it will make you one of the better investors, right? And I think that is important. Particularly when we manage fund, we are managing several mandates, right? So we have about 20 to 23 different equity and hybrid funds, and each mandate is slightly different. So for some mandates, we are more pro growth, and we will accept a higher valuation range. For some mandates, we are kind of we have a larger set of investors where we want to provide a more consistent experience. So there we would be a less aggressive in terms of chasing growth, etc. So I think you have to set your broad principle and framework in place and operate within that. Right. Of course, it does not mean that we will kind of avoid all mistakes. So, for example, even in the last couple of months, it's not that our funds have not pulled back. So, our funds have also pulled back, right? But we believe that these ups and downs are par for the course. And if we are in the right companies, if we are in the right stocks, over the period of time, they will provide good return to investors.
Right now, Ashish, as the CIO, you oversee strategy instead of managing funds directly. So, why stay in the strategist share? And do you ever see yourself managing, an equity scheme yourself?
I think the first reason is that we are fortunate that we have a great set of fund managers. So now actually we have 10 equity fund managers, each doing an excellent job. So that makes my job easier, and therefore I don't really need to step in and get into fund management. But also strategically, when I came on board 2 years ago, that's the decision that was taken, that we need to set our investment team in a manner that we don't have just one team running in our portfolios, right? And as I mentioned, we have 23 different schemes. Each scheme has a slightly different mandate, and we want fund managers to be running true to that, true to label. And I think it is really important that we have each of the funds really reflecting the personality of the fund manager, right? So while as a team we have some shared beliefs, we have some core principles that we follow, we want to give really each of the fund managers independence to run their schemes, right? Our style across funds continues to be around quality and growth, but different people have different definitions of growth and right. So, for example, I have a fund manager who's playing growth through consumption, and in a different fund manager is playing growth through capital goods and real estate, right? And that could just be a function of how acceptable certain valuation ranges are to one fund manager versus the other fund manager. And I see my role as being one who's kind of making sure we have in all the decision making across the funds have common principles guiding these investment decisions. Also, we have appropriate guardrails around this. So, for example, one of the guardrails we have put is that we no longer in any fund take an active weight of more than 5% on any large cap stock. Right. And for the mid and small cap stock, the cap on active weight is plus minus 3%. So we want to ensure that even as we seek return, it is done in a more risk calibrated manner. Right. So these are the guardrails that I want to ensure, and that's really the role I see myself playing rather than really a second guessing of fund manager.
Ashish, just wanted to understand one thing. Being a CIO, how do you bridge it between the fund managers and the research team? So, what exactly will be your role in terms of helping on the one side the fund managers and on the other side the research team? How do you do it?
Yeah. So we actually also have a head of research today who's guiding the research team on a day-to-day basis. But again, I have nearly 20 years of experience of managing research teams. My interaction with research team is in three different manners. So one is we do meetings together with the analysts. I would be meeting companies. I would be meeting sell-side analysts. Along with the fund managers, we have a morning meeting where we discuss the ideas with the research team. Weekly, we have every week one research analyst doing a deep dive on his sector and presenting to the entire investment team. We also have put in some, I believe, very strong research processes over the last 2 years and expanded our coverage. So, in the last 18 months, we have added nearly 100 companies to our research coverage. And most of these are actually non-IPO companies. So we have made sure that our coverage universe continues to expand. And both as the research team has expanded and coverage universe has expanded, we want to make sure that we are able to really assess a research analyst performance also on an objective basis. So one of the things we have instituted is that not only are fund managers assessed objectively basis their performance versus benchmarking versus peers, a large part of analyst KRA is dedicated to how his model portfolio performs. Right,
Okay.
and that is helpful not just on having doing it objectively. It also helps a lot in internal communication. So now, when we have a large 20 plus member investment team, it's very important that we have ability to communicate well within the team, and model portfolio enables a research analyst to convey his conviction to a broad set of fund managers. So I think that's where I see my role in terms of both setting the processes and framework for the research analysts to operate in, and again, working with them as we meet companies and think through the investment.
Now, Ashish, after 2 years at Axis AMC, what key changes have you made to enhance strategy, research, or the risk management framework?
So if I kind of bucket it in three ways, right? So people, processes, and portfolio, right? So on the people side, one of the key changes was that to really build out the investment team. So when I joined, we were 4 fund managers. Today we have 10 equity fund managers. We had a team of 7 analysts. Today we have a team of 16 analysts. So we significantly expanded the team, and the reason was that the Indian market had grown. Now there are multiple sectors, multiple themes, and stocks to cover. Right. So today, as investment house, we are covering nearly 450 companies. So this number has literally doubled over the last 2 years. So we wanted to have a larger span of coverage. I already spoke about the fact that we also wanted a larger set of fund managers managing the products, because earlier multiple products were being managed by the same fund manager. So it was leading to a kind of big calls on time of the fund manager. Also, there was very high commonality across the funds he was managing. Right. So if you're running funds very actively, it's very difficult to have distinct funds. So that was a big call out that we made, that we will have a larger set of fund managers. And now on average, each fund manager just manages the 2 schemes. Right. We were quite fortunate that we were able to attract very good talent for this. So now we have a very experienced team across research analysts and fund managers. Our average experience level is about 15 years. Right. So that was on the people side. On processes, as I mentioned, we changed the research process quite significantly, including bringing in the model portfolio. We changed the investment process in terms of putting some guardrails around it, or tightening some of the guardrails. On the portfolio side, one of the observations that we had 2 years ago was that our portfolios were very, very concentrated, right? 2 years ago, we had nearly 17%, 18% of our total AMC AUM just in 5 stocks. Right. And the reason for that was twofold. One was that we had high degree of commonality in stocks across various schemes, and secondly, within the schemes, the top 5 and top 10 stocks was a very large part of the AUM. So we changed both of that, right? As I said, for reducing the commonality, we said the best way to do it is have a wider set of fund managers, but each investing with the same core or principles and some similar beliefs, right? And the underlying investment process and the coverage universe is the same, right? The second was that within each scheme, we said we will cap the active weight you will run on a single stock, right? And the outcome was that for many of our scheme, top 10 stock used to be 65% of AUM. Top 5 stock used to be 45% of AUM. And that's come down. So top 10 stocks are now roughly around 42% of AUM of most schemes. Top 5 stocks are about 25% of AUM. The commonality across funds has come down by about 18 percentage points. So if you look at the concentration level at the AMC level, top 5 stocks are now only 9% of AMC AUM, right? So that was one thing we did. Of course, even as we diversified, we were quite clear that we are an active fund manager. So we will continue to run the fund very actively. So the active weight in our portfolios has not really changed. So in most of our schemes, still about 70 to 75% is the active weight of the portfolio. But that active weight is spread across more number of stocks rather than being concentrated in a few names, right? So that was one change on the portfolio. We also said that the challenges on the performance side was not just restricted to really growth or value. It was also a function that India's economy, India's market had changed from the previous decade to this decade. There were a lot more themes that had come in. So, for example, if you go back to the previous decade, really financial and consumer were the only two themes that were there in the market, right? So we kind of made sure that the multiple underrepresented themes also found a way into the portfolios. And for that, as I mentioned, we expanded our research team so we could get a lot of new ideas coming into the portfolios. We also made sure that companies that were not performing were weeded out of the portfolio. And again, this does not mean that all historic stocks were kind of reduced in concentration. In fact, companies that were delivering, we actually doubled down on, we increased the weight on the portfolio, but companies that were not really performing up to the expectation, they were systemically weeded out of the portfolio. So I think all these changes really have helped us kind of get to more desirable investment outcomes. It has also reduced the volatility and correlation among our funds.
Right. Now, she's several flagship funds, be it Axis Blue Chip, Tax Saver, Mid Cap, Small Cap, Growth Opportunities. They topped quartile 1 over the past year, yet lag in quartile 4 over the 3 and 5 years. So, what is your roadmap to lock in that top tier performance long term?
So, as I said, we had these performance challenges over the last 3 years, or actually last 4 years, right? And there were 2, 3 reasons for that. One was, as I mentioned, because we were concentrated and some of those companies were not performing well, we had to weed them out. Second, there was a big re-rating of value stocks, particularly in 2021-22 period. But actually, if you see now, their multiples are very similar to the market multiples, right? So over those 2 years, we faced that challenge as well. As I look forward, I think the good thing is that now we are very comfortable with our portfolios across all our schemes, not just these schemes, but even if I look at our flexi cap fund, our multi cap fund, our focus fund, so most of the portfolio changes that we had to make, we are happy with. But of course, we continue to keep a very close eye on whether the industry and the companies are performing to our expectation. And the good news is that because our size of positions is much more manageable, if there's a change to be made, we can be much more nimble about it, right? So I think the diversification has helped us get more nimble, and really there are kind of 2 ways to come back from what we had endured, is that we make some very large aggressive bets and try to recoup the performance. But the challenge with that is the sustainability of that is always a risk, right? So we wanted to kind of make sure that we generate alpha, we generate consistent alpha. So even if it is kind of smaller doses of alpha every month, but we want to have consistent alpha generation over this period of time. And as I look forward, I am quite confident that we will continue to do so. But that does not mean that within the next 3 months or 6 months, you will see our 5-year performance also improving, right? So that will happen only gradually over a period of time, both because we hope to continue generating positive alpha, as well as kind of the base effects starting to play out. But what I'm tracking is that what is the standard deviation of alpha, what is the range alpha is being generated across funds, and how consistently it is being done. Of course, it does mean that the 3-year, 5-year performance will take time to kind of reflect. But the good part is that anyone who joins us in this journey, right, will have hopefully a favorable investment outcome.
Ashish, you explained the broadly about the performance, but could you just specifically say about what the portfolio tweaks were, like sector bets or the stock picks, which have fueled the recent uptick in the fund performance?
Sure. So that's the good part, Chirag, that there is no single or no set of stocks that I can put really the driver for our turnaround in the performance. So if you see the top 5 stocks in the funds which Chirag mentioned, so whether it is blue chip or it is multi-cap or growth ops, they are very, very different, right? So just to kind of answer your question more directly, and I'm not trying to avoid giving any names, but the fact is, if you look at our blue chip fund, right? So our blue chip fund has strong overweight on banks, right? If you see our small cap fund that has underweight on banks, right? Our blue chip fund has low exposure to capital market names. Small cap has large exposure to capital market names, to EMS names, etc. While FlexiCap has exposure to industrial names and real estate. So that is really the beauty of having a wider set of fund managers, that we are really not betting on one thing or one theme. And as I said, we are looking at exposure levels to a stock at the AMC level as well, and not just at the company level, right? So the stocks that have driven the performance for blue chip versus stocks that have driven the performance for multi-cap are very different. So I would not kind of like to say that there is one sector call that we got right and that turned it around for us.
Okay, now while there has been an uptake, but top fund houses, they grew AUM by 45 to 75% in the last 2 years, and Axis AMC's 35% growth, it trails behind.
Yeah.
So how do you plan to win over investors and close that gap? While you answered that in bits, but still.
No, I think it's a journey. I think what we need to make sure is that we provide good, consistent investment experience for the investors. We also need to ensure that we have our strategy. So it's not just performance, but strategy and thought process for each of the funds communicated well, not just to the investors, but to the distribution community as well. Right? So I want to make sure when an investor is coming in, he knows what is the fund manager's thought process, right? So, for example, our FlexiCap fund is more aggressively positioned than our ELSS fund. Right? So I don't want an investor coming in to have a different expectation, right? So in a rising market, our FlexiCap fund will do potentially better than an ELSS fund, but in a more conservative market, ELSS will do kind of better than flexi cap fund, right? So those are the fund characteristics, right? But I think we need to ensure that. I think the other thing, and on an overall AUM basis, couple of places as a AMC we have been under indexed is both on hybrid funds and passive funds. In fact, our balance advantage fund now is top quartile even on a 3-year and 5-year basis, but it is not something that we have showcased consistently over the past many years, right? So we want to make sure that even on the hybrid side and passive side, we get our due market share in the product. So I think getting the equity funds right and communicating well with distributors and investors, as well as really making sure that our hybrid and passive funds also gain relevant market share would be our strategy to really bridge this gap.
Ashish, now coming particularly to the equity markets, we have seen markets correcting by 12 to 15% depending upon the index which we look at it. And especially the stocks in the mid cap and small cap has fallen by more than 40-50%. Do you think, is there any red flags signaling a deeper trouble, or do you think it's a normal correction in a bull market?
So I think one thing I want to highlight is that I think over the last 2 years, again, one of the narratives is small and mid cap versus large cap, right? And I think it's not always right to contextualize everything in these cohorts, right? To give you an example, look at Nifty 50 and Nifty Next 50 and the mid cap index and the small cap index, right? So large caps is the top 100 stocks, right? But the real differential in performance is between Nifty 50 and Next 50. So if you look at Nifty Next 50, that index has actually performed exactly in line with the mid cap and small cap index since September 26 for the market peak, right? So it's also down 20-21%. Your mid cap and small cap are also down similarly, right? So it's the Nifty 50 which has outperformed, but within so the point I'm making is that it's not really large cap versus mid cap, small cap. I think what it is important to see is what is really the valuation and where there is a growth disappointment, right? So in the Nifty 50 or the top 20 stock, the multiples were at a discount to historic ranges because already in the past 2 years, not much growth was coming in, and these sectors and stocks had got derated. Conversely, many cyclical stocks, many of the smaller companies had rebounded very strongly after COVID and were growing earnings at nearly 28-30% CAGR. Right? And they had got re-rated. So there was a significant expansion in multiples, and whether it is a large cap or the mid cap or the small cap, wherever there has been a disappointment in growth and the multiples were elevated, that's where we have seen a deep correction. And I think that outlook appears to likely to continue. There is some rebound in the economy that is underway, but it is unlikely that this year we will go back to a growth rate of over 7%. So I think compared to the last 2-3 years, earnings growth will be much more modest. So if you see over 21 to 24, earnings growth in the industry across industries was around 18%. This year, earnings growth, even for the Nifty, will be down to about 7-8%. Next year's earnings growth is forecasted to be around 13%. So because there is a slower pace of earnings growth, it is but natural for the multiples of the previous years to unlikely to come back, right? So I think yes, the India's growth story is still intact. We will still get 6.5, 7% growth over the medium term, but we have had excessive uh, earning growth as well as market returns over the past few years. So I think as I look forward, we should expect a period of much more moderate return, both because multiples are elevated and secondly because earnings growth is more modest. Uh, the good thing overall, though, is that we find that it is only a P&L problem. It's not a balance sheet problem. So if I look across corporate India, there is no major or overhang of debt across any of the companies. If I look at the banking sector or the NBFC sector, there are no pockets of vulnerability or asset quality mismatches like we saw in 2018-19. So really, I don't see a challenge on that aspect that there is a leverage issue anywhere in the system, including in the stock market. So even in the stock market, I think the leverage positions are not that large. So the system overall is very healthy. So I don't see a major accident happening on account of that. Of course, what we need to make sure is that we get back to mid-teens kind of earnings growth for corporate India. And as that happens, you will get really investment returns of that magnitude.
Ashish, with valuations stretched in certain pockets, how are you finding quality businesses that still offer value?
So it's a challenge, and I think today, fortunately or unfortunately, whether businesses quality or not quality, valuations are expensive across the board, right? So I think it's very difficult to find quality businesses or growth businesses at reasonable valuation at this point of time, really across sectors. But therefore, we are focusing on our companies where the earning risk is low, because many of these companies are also sitting on very elevated margins. So we believe the earnings risk is going to be higher in those pockets. We are also trying to differentiate among companies by really the amount of value addition they are making, right? So what is the value add in the product or in the process they are providing, how competitive that is, because it's going to become mainly increasingly challenging, right? Because with all the tariffs challenges coming in, there are many companies in India probably where margins were elevated because India over the last 7 years had increased protection for its industry. So that may no longer be viable going forward, right? The third thing we are looking for is really which companies have this earning growth potential where the visibility is longer, right? So while the valuation may not be cheaper for company A versus B, but if company B, we can be confident of that earning growth trajectory for a longer period of time. But your question is very pertinent that even after this correction, there is no kind of cheaply valued, high quality growth company.
Ashish, your House of Debt report exposed crack in the Indian banking system. Today, where do you see the next structural risk that could rattle markets or economy? It could be even international things, if you, because as you mentioned, there are no balance sheet risk at this point of time. But is there any particular in the global markets also which could impact the markets and the economy?
So I think really the global boundaries are being redrawn, right? And with boundaries, I just don't mean physical boundaries, but really economic boundaries in terms of how tariffs are playing out, how alliances are being built. And it's really important that the Indian policymakers make those right choices. because the cost of a mistake can be really high for corporate India, right? Because globally we have seen polarization happening. Demand in the global economy is really emanating from one pocket, which is the US. And really, on the supply side, China has made even stronger headway into its cost competitiveness, and more importantly, even on its technology capabilities, right? So even though India has been trying to being increasingly wary of China, India's dependence on China in terms of import content has continued to increase, right? So whether it is for our push into renewables or electric vehicles, robotics, literally China is really the key supplier for us as well as globally. Right. So I think that is the big challenge that we have to see, that how policymakers kind of address this risk, because we and our companies still need access to the global markets, including the US. But if you take down really the protection the domestic industry has, uh, very few can really compete with the manufacturing capabilities that are there in China, right? So I think that's a risk. I think that is also in some ways holding back the investment cycle, because companies are not willing to put in new investment plans when there is uh, oversupply or glut in several global commodities, right? So whether you look at refining, petrochem, etc., there's a global overcapacity. So even though domestic demand supply balance and capacity utilization levels are running high, we are not seeing enough investments coming into these global sectors in India.
Right now, Ashish, before we let you go, here's one last question. We all know that the markets can be full of surprises, but what's the most unexpected twist that you have seen, and how did it affect your investment strategy?
I think one thing, and this was a learning after the GFC, right, for me, is never fight the central bank. So I think the kind of blow up we had in the US in 2008, I thought US markets were done and dusted with for the next decade. But really, the central bank actions that came in, and this always happens in a crisis, right? So you see a crisis happening and central banks coming in, and all of us comment that, oh, this is not going to be enough, right? But actually, if the central bank is very clear that it wants to get it done, it eventually comes through. And we saw from 2009-10 US economic growth for the next decade had been, and it has been superlative, right? Just because there was so much monetary infusion. The same thing we saw in 2012, right? So when Draghi made that comment, I'll do whatever it takes. In 2011, if you recall, Europe was facing a sovereign debt crisis, and Draghi said, I'll do whatever it takes. And European fundamentals did not change, right? But the fact is, European markets returned 20-25%, even with those fundamentals, because the central bank came in. And I think we, in the last few weeks, are seeing similar thing in India, where the central bank has not explicitly said it, but if you see their actions on the liquidity front, if you see their actions on relieving all the controls they had or restrictions they had on the banks and NBFCs being pulled back, so clearly the central bank is saying that I want growth back.
Yeah.
In the short term, we are not seeing the impact of that as much as we would have seen, because foreign capital outflows are continuing. So the liquidity situation had not turned on its head. because RBI is putting money in a leaky bucket, right? But that tap will slow down or shut at some point of time, and that's when you will see really the full impact of RBI actions on economic growth, and of course also on our markets.
Right. Well, with that, it's time for us to wrap up this chat. Thank you, Ashish, for taking the time for this interaction. It was a pleasure speaking to you.
Okay, thanks, Chirag.
Thank you.